Welcome to episode 4 of So You Want to Buy a Business. My name is Kira Hamilton, and I'm a business owner and SBA loan broker. This podcast is all about the ETA journey, how to find, finance, acquire, and operate an SMB. My guest today is Sterling Birdsong. He's an SBA lender with BayFirst National Bank and also a franchise owner. Let's get right into the conversation. Hey, Sterling, how are you?
I'm doing well. How are you doing today?
I'm good. I'm Kira. Nice to meet you.
Yeah, nice to meet you as well.
Definitely excited to talk SBA with you and ETA. Got a lot to cover. Thanks so much for taking the time to chat with me. I'm looking forward to picking your brain. And you want to start with an
Sure.
introduction?
Yeah, sure. So my name is Sterling Birdsong. I'm an SBA Business Development Officer here at BayFirst National Bank. I've been in SBA Lending since 2016, been in banking since 2012, started out on the underwriting side, did that for several years before coming on to the sales side. And I don't ever think I'm going back. I never looked back. I enjoy the sales side of things, and that's where I belong, and that's where I'm going to stay. And been blessed to have a lot of success here at BayFirst over the last several years. So yeah, that's the background on me.
And you also own a business, correct? Can you tell me a little bit about that?
Yeah, absolutely. So I own a couple right now. So I have Two Maids and a Mop, which is a residential cleaning franchise, and that's here in North Tampa area, Pasco County. And I also am in the process right now of building a glow tanning salon. So that'll be open here, hopefully late June, early July. And then I also have some real estate investments as well. I own a quadplex and another single family rental. So, we stay busy.
Sounds like you're a busy guy. Let's start with your acquisition. When did you acquire your franchise?
Yeah, so I actually started that. So I used an SBA loan to start that, and I started it actually about 3 weeks before COVID. We opened up, so it was a pretty wild time. But I actually used United Midwest Savings Bank. Shout out to Fred Crispin and his team over there. But I got a small SBA loan for $150,000. That's all it took to get us started. And so, yeah, that's how we did it. So it wasn't an acquisition, but it was certainly, using an SBA loan to essentially fund entrepreneurship.
What made you want to start a business in general? And then how did you come to the point where you were starting that particular business?
Yeah, so I wanted to go out and be an entrepreneur. Actually, my degree is an entrepreneurship degree from St. Leo University. So I've always kind of had in my mind that I was going to go out and do something entrepreneurial. But first, I had to go pay the bills, right? I had to figure out a career and a way to, get on some type of stable footing so that I could create some type of income to then go on and kind of further my goals and my dreams. So that's what I did first. But the thought process was always that I was going to eventually be an entrepreneur. And I think that long term, that's where I see myself as well. Don't worry, anyone from BayFirst who's watching this, I'm not leaving, but eventually, I see myself going more the entrepreneurial route. So that's the ultimate goal for me. But the reason I ended up with the maid business was because I actually spoke to a franchise consultant who was I was put in contact with by just a mutual contact, and they told me, hey, you should talk to this guy, because I knew that franchising was going to be a best fit for me personally.
Hmm.
Reason being that I have a day job still, right? I still have to be able to work at the bank full time and be at my highest capacity here, while at the same time trying to work on another business on the side. If you're going to do that, you need some type of framework, in my opinion. You need systems and processes that are already put into place for you, so that you can mainly focus on execution, and not actually trying to create a business out of thin air from scratch, which can be extremely difficult. I think that if you're going to do either a startup that is from scratch, or you're going to even acquire more of a mom and pop type, or an SMB type business, realistically, you probably should be leaving your employment to go do that full time. I think that's probably the appropriate way to do that. You kind of have to burn your boats and take that route. Otherwise, I don't know that you're ever going to learn the business enough to be successful in it. In my situation, I have another partner who's involved in that as well. So we both work full time, but we're able to kind of split the responsibilities there. And then we also have a manager who works full time, plus the support of the franchise. So it just made a lot of sense for us. And we liked the cleaning model because we felt like it was more scalable. We looked at some other franchises. One was in the fitness space. I don't like the fitness space at all, personally. I think it's oversaturated. I think that you're competing with all the big box gyms. You're competing with Orange Theory Fitness. And now you're competing with YouTube, too. There's YouTube influencers that, have millions and millions of subscribers. So you can work out in your living room. So I felt like it was oversaturated. The other one was Eyelash Studio that we looked at pretty closely. And eyelash studios do pretty well, but I'm a realist, and I realized that there could be a day when somebody doesn't show up for work in the early days, or when I lose a manager or something like that happens, and all of a sudden I have to step in and run a business. And realistically, I can't put eyelashes on you. You wouldn't want that happening. That would be a nightmare for all of us. So I said, hey, I have to at least do a business where if push comes to shove, I can step in for a couple of days. And best believe I was out there in the field cleaning. I've done probably at least 10 cleans, since I've owned the business. So, that those days did happen where, we lost people, and we had to decide if we were going to cancel an appointment, or if myself and Sherman were going to go out there and do a cleaning. And we went out there and did those cleanings. So, I think in the end, it was a good decision to go that route. But yeah, that's what led me to, that's my thought process, and what led me to using the SBA loan to do a startup for a maid franchise.
I really resonate with quite a few of the points you just made. I own a laundromat, and I was working a typical 9-to-5 job in commercial real estate before we acquired. And then I decided to leave the job when the purchase went through. And I'm really glad I did, because I spent 14 days straight at the laundromat, learning how it worked, learning how to do wash and fold. And I think that was so important for me. One, because yeah, when you own a smaller business, you never know when someone's going to call out. You need to understand how to step in. And it also gave me the opportunity to learn how to set expectations for my employees, because I know how long it takes to wash, dry, and fold 50 pounds of laundry. I've done it myself many times. And if I didn't know what that was like, how long it takes, all the things you have to do when you're at a laundromat, it would be hard for me to hold realistic expectations for my employees. And I, like you, would not be able to apply eyelashes on anyone. So I'm a big believer in, understanding the service that your business is providing, and, to a certain degree, being able to provide it yourself. I'm really interested to be educated more on franchises, because I don't know, I've never owned a franchise. I don't really understand the inner workings. So I'd like to get some more information from you about that. It sounds like you didn't acquire an existing location, but I'm not quite sure the terminology to use. Did you buy the rights to start up your own franchise location?
Yeah, exactly. So franchising can work, a couple of different ways. Sometimes franchises will have you buy territory, which is more so how it works with the two maids, for example, where, I have rights now to Pasco County, Lutz, and Odessa, which is essentially North Tampa area. So there's not going to be another two maids that can come into my territory and open up an office, right? So you'll pay a franchise fee, and that's for the right to actually use the name and get the secret sauce that Two Maids has, their business model essentially. And then sometimes you may pay the territory fee on top of that, which is how it works with Two Maids as well. And they kind of calculate how much the territory is based on the doors essentially that are there in that territory. And then you pay an ongoing royalty to them as well. So typical royalties for franchises are going to run about 6% of your revenue. And then usually there's another additional 2% for marketing that's tacked on top of that. And that's for overall marketing of the franchise itself. It's not for you individually per se. It's for Two Maids as the brand to be able to continue to market Two Maids to the world. So that's the way that would typically work. And, what you usually get in response for that, in return for that, essentially is, hey, you get the business model, so you don't have to think about how to actually create a working business model. You get the hiring practices. You do, get the marketing that comes with it, and then you just get general support. There may even be things like, for example, like a call center or something like that is general for the entire franchise system to use. And then, you get the name, image, and likeness, right? So you get the ability to say, hey, I'm a Two Maids. And depending on what franchise system you're buying into, that could mean a lot, right? Because maybe that name is McDonald's, right? Where it's like a huge, massive name. And it's like, hey, just because you are McDonald's, there's a certain amount of people who are going to show up because of that, right? So those are the type of things you have to think of when you're trying to weigh out whether or not you feel like it's worth it to buy into a franchise, because you are giving up money by doing it 100%. So you have to kind of weigh out whether or not you think the juice is worth the squeeze.
You're selling me a little bit more on franchises. I've been skeptical. Like I said, I've never purchased a franchise myself, but you're scrolling on Biz Buy Sell and franchises pop up. And personally, I've had the perception, and I haven't done really a whole lot of research into any particular franchise, but that it seems like it could be a bit of a headache, a lot of paperwork. You're beholden to this corporation, a lot of fees involved. But it sounds like there is also a support system in place. Now that you've owned a franchise for a few years now, what have you thought of the experience, and would you buy another franchise?
Well, yeah. So the answer to that is yes, because I'm building another one right now. So I'm in the process right now of building a glow tanning salon, which is
Oh, and
another
that's a franchise.
franchise.
Got it.
Yeah,
Okay.
that's a franchise as well. And I met the CEO and founder, Ani, and me and him just kind of hit it off. And we decided that we were going to do a location there. They are franchising now a lot more rapidly. But when I came on board, they only had 5 franchisees. So they had a lot of locations, but they only had 5 actual franchisees. And so I would have been, I think I was the 5th one that actually came on board there, just because they were very selective. To this day, they still haven't had any failures in the system, so they want to kind of keep it that way. But they will be at almost 100 locations by the end of this year. So they are growing fairly rapidly. And one thing I liked about glow tanning in particular was that the biggest franchisee is Ani himself. I mean, he's in the process right now of, I think, building 15 more locations for himself personally. So he is, he's a real drinker of his own Kool-Aid. He's not just, saying, hey, I'm the franchisor, this is how you do it. No, he's also the franchisee as well. And he's very frank with the fact that, most of his money that he makes is as a franchisee. It's not as a franchisor. I definitely like that. And yeah, I think franchising can be great if you have the right franchise, right? It's like picking the right horse. That's really what it comes down to, because there are franchises that fail as well. Franchisors will fail. I have seen it happen before where they've essentially just filed bankruptcy, and then all of a sudden, if you're a franchisee, well, guess what? Now you just have a mom and pop business, so you don't have any franchise support anymore. And then what you see happen in those situations is some people, they still make it. They still make money. They're, just good business owners, and they kind of figure it out. And other people don't make it. They kind of just, wither away once they don't have the franchise support. So, it is important that you are lending into the right franchise system, buying into the right franchise system. When it comes to us in lending, we also are particular about which system we're going to lend into. We won't lend into a system that has less than 50 units operational. If you feel like if we have less than 50, we feel like you're still kind of figuring it out. And we feel like, it's just a little bit too early. And those are the ones that usually do fail if they do shut down. It's usually the ones that have less than 50 units operationally because they just haven't quite gotten to that scale just yet. So yeah, to answer your question, I mean, I still think that there's value in a franchise. I think it's all about picking the right franchise. And also the thing with franchising that I also will mention is really franchising is a scale game. So it's really about not just having one location, it's about having multiple locations. If you really want to make money and you really want to make it a career for you, I don't intend to just do one glow tanning salon, right? I would like to do 10. And then once you have those economies of scale and you have multiple locations, that's when the income that you can make as a franchisee really starts to multiply at that point. So that's my thought process on it.
Tell me a little bit more about that plan to scale. What kind of timeline are you working with, and what steps specifically do you want to take to get to 10 salons?
Yeah. So the first step is getting one open. That's the first step. And that's what we're working on right now. We're in the construction phase. So I was open with Ani as well, and just telling him like, hey, we just got to get one first. We got to crawl before we walk. I have to open one up. I need to get it cash flow positive. I need to understand the business and the way that it operates. And then once we kind of have that platform for growth, because your first step, you just don't want to be a misstep. You don't want to go open a tanning salon and then all of a sudden that one's losing money, and now all of a sudden you're tied into doing store 2 and 3, and now you are potentially throwing good money after bad. Those are the type of situations that you obviously want to avoid, because you might run out of money before you actually get a chance to scale. So the first thing is getting some stable footing, getting one location open, and then you go from there. But it's kind of a one step at a time process. It's not a, hey, we're just going to go from 1 to 5. I probably go from 1 to 2, and then maybe from 2, maybe I'll go to 4, right? So once I say, hey, I've gotten 2 cash flowing locations, now I'm really comfortable. I really have some stable footing. Now let's get a little bit more aggressive. Now let's say, hey, we want to do 2 locations at the same time. And you got to think about it from a lender's perspective, right? Which I'm very good at doing because I'm a lender, where I say, hey, would I lend to me? If I had only one location and it was failing, I probably wouldn't, right? But if I have one location that's cash flow positive, I'm going to do the second location. If I have 2 locations that are cash flow positive, okay, I'm comfortable with you signing 2 different leases at the same time, doing 2 different build outs at the same time, because you have experience at least doing 2 build outs previously. And so, hey, I think this guy is somebody I can get behind, and the other ones are still making money. So, that's kind of how you have to approach it. Or just remember that, a bank only wants to lend to somebody that they think is going to pay them back. So you have to look good when you're talking to the bank. The famous thing they always say is that a bank will lend you an umbrella and then ask for it back when it's raining. Right. So banks want to help people who don't need the money and who are in a good position, is basically what that means. They don't want you to come to them crying once something goes wrong. So yeah, I think it's really a step-by-step process. And for me, to get to 10 locations, that's maybe a 5-year goal, but at the same time, I always stay flexible. Maybe it can happen sooner, maybe it'll happen slower, but it'll happen in the right timing as long as you make the right decisions on a daily basis.
Let's talk a little bit more about the nuances of SBA for franchising. You mentioned you got an SBA loan, you're an SBA lender with a lot of underwriting experience. You mentioned you look for a certain amount of locations open, in your case, 50 minimum. What are some of the other specifics that a bank would be looking for in underwriting when it comes to a franchise as opposed to a more, typical non-franchise acquisition?
Yeah, sure. So again, it goes back to royalties. How much you're going to be paying in royalties to the franchisor? What type of support are they offering you? That's going to be important as well. Obviously, we talked about the locations. I mean, those are really the main things. And then obviously, if it's a retail location, we're also going to be digging into leases as well for doing an acquisition, trying to make sure that you actually have the ability to stay within a property for the duration of the loan. That's something that we run into quite often with these retail locations is, hey, I have 4 years left on my lease, and, we're trying to get a 10-year loan. Well, that's not going to work. You need to go back to the landlord and you need to ask them to grant an extension. And if they're not willing to, well, then we can do it on 4 years as a term, maybe to match the term that you already have, or we probably, and most likely in that situation, are just going to pass on it. The one thing I would say that is an advantage for somebody who's looking to acquire a franchise versus someone who's looking to acquire a typical SMB type of business is that because of that support that's added by the franchisor, and because of that training that you can get as a franchisee, sometimes we're comfortable with a little bit less industry experience from a guarantor. Whereas if it was somebody who was buying, a solo business, an SMB, we really harp on how much direct industry experience you have and what you're going to be purchasing. We don't want a situation where you get into a business that you really don't know how to operate whatsoever, because that can really cause big issues. You don't see that happen as much with the franchise because, again, the guardrails are kind of there for you. to the point where, some franchises, like if you read through the actual FDD and the franchise agreement, they don't really let you mess up too much, because the guardrails are so tight in what you can, what you can post on social media, or, what you're able to offer in your stores. It better be their product. You're not going to go to, you're not going to own a McDonald's and all of a sudden start serving Pepsi products, are you? You're going to stick to Coke products. So some of those franchises, they do have tight reins on you, which from a bank perspective, I think can be good.
I work with a lot of people who are looking to make their first acquisition. And, that's interesting because you mentioned franchising could be a good option if you haven't owned a business before. If you don't have direct industry experience, that could give you an easier way in. What other advice do you have for people who are looking to make their first acquisition? What would make them attractive to a lender? What types of questions should they be asking themselves in the search process?
So the first thing is it's just money. First of all, we need to know where your down payment is going to be coming from. Do you have the down payment to be able to accomplish this? Because in most situations, and we can get into what the SBA rules are in regards to equity injection, how they've changed recently, because there have been some really substantial changes in the last 12 months. But the first thing is, we typically want to see you bring 10% to the table as an equity injection. So if you're buying something for $1 million, it's about $100,000 you're going to have to bring to the table. If you only have $50,000 in total liquidity, the business might just be too big for you, or you need to go find somebody else who's going to assist you with this down payment, investors, or another partner that's going to come on board that has deeper pockets, whatever it may be. But that's the first thing you really have to ask yourself is, can I actually afford to go out and buy a business? If you can't afford it, then you better start getting creative really quickly, if that's the decision that you're going to take. Besides that, then it goes into experience, as I mentioned earlier. That's going to be the second thing. Yeah, okay, you have the money to buy a business, but do you actually have the experience to run a business? Deep down whether or not you would be a good entrepreneur, whether or not you feel like you'd actually be able to operate this business. If you're in a business that's maybe has a high barrier of entry, or maybe it's licensing intensive. You have to have some certain type of license to be able to actually operate the business. In those situations, you need to come up with an answer as to how you're going to make the bank comfortable with the fact that you don't have a license. Maybe you can go out and find a partner who has a license, or maybe there's somebody who already works at the business that has a license. Maybe you can give them some type of minority ownership, 1%, 3%, whatever it is that you can get them comfortable with and that you're also comfortable with, or lock them into some type of employment agreement. So at least that it's difficult in the event that they would try and leave. So, a bank's going to want to essentially just understand that there's not risk in the fact that all of a sudden you're not going to be able to operate this business anymore. That's really the most important thing. So I would say those are the biggest hurdles that I see right out of the gate, where a lot of people just kind of get tripped up on, where it's like, hey, if you don't have the money and you don't have the experience, this is going to be a pretty short call. I just, we can't help you out if you don't look like a good candidate to be able to go out and make an acquisition.
You brought up the SOP changes specifically related to cash injections. Can you go a little more into detail on what were those changes and how do you see them affecting the deals that you work on?
Sure. So the biggest change was that the seller note now can be used for the full equity injection. So again, typically the bank is going to lend 90% on a business acquisition. So you have to find a way to make up that 10%. That's your equity injection. So again, we'll use the example of $1 million total project amount, inclusive of closing costs, everything. It comes to $1 million on the dot. So you are on the hook for $100,000. So what the SBA will allow you to do now is, if you can get the seller to agree to holding a note for $100,000, and that note stays on standby for at least 2 years, then it is eligible to be considered as the equity injection for your SBA loan. Okay. One more caveat to that is that after that 2 years, that note cannot balloon. So it has to fully amortize out. They don't specify what the amortization needs to be, but we'd obviously want it to be an amortization that's not going to kill your cash flow, so it doesn't work anymore from a debt service coverage standpoint. But essentially, you can get a little bit more creative on what the actual amortization is going to be. But that's a huge deal because you used to have to really find that 100,000. Typically, it was coming from you, and there were some. You were able to use half of it previously prior to the change. So essentially, before they made the change, you could have done 50,000. That would have been in the standby note for 2 years, and then the other 50,000 would have had to come from you. So they moved it from essentially 50% to 100%, which is a really, really big deal. It kind of, again, lowers the barriers of entry, because I think that the perfect person for that type of deal is somebody, so for example, who maybe works in the business already. Maybe you have some type of a GM or something like that where they already have the skill set to be able to run this business, but maybe they just don't have the pockets to be able to make a substantial down payment. But this person is the absolute best person to run your business, to take it forward, keep your employees in place, keep everybody happy. But hey, they don't have $100,000. Okay, no problem. Well, you can hold the note for that 100,000 that would allow them to actually get into this business. And then on top of that, the bank could even lend them some working capital, so they have some cash in the account from day one, so they don't just immediately bottom out. So that is by far the biggest change that's happened recently. And I think that it's something that I have seen. We did do a deal with that structure towards the end of last year. It was a $4 million acquisition of a candy shop actually in Georgia. And we were able to get comfortable with it because, well, two reasons. Number one, the guarantor had amazing experience. He was actually in the Candy Makers Hall of Fame, which I didn't know was even a thing. But you can't get better experience than being in the Candy Makers Hall of Fame to go buy a candy store, right? So that was one thing. And then he also brought a substantial amount of free and clear real estate to the table that we took as collateral. So we felt like, hey, that's adequate skin in the game. You don't need to bring cash. If you can talk the seller into holding the note for 2 years, we're comfortable with that. And so that's how we closed.
I'm glad you brought up borrower's experience, because even though there was this SOP change, even though technically you can source the equity injection from the seller note, in practice, you're not going to do that for every borrower, right? There are other pieces that need to be in play. And it does sound like if you are bringing less of your own capital to the deal, then your experience is going to be more important. Would you agree with that?
Yeah, I would agree with that. And I like what you said there. There's two things going on here, right? There's what the SBA will allow a bank to do, and then there's what the bank will actually do. And those are not always the same thing. Just because the SOP says that you're allowed to structure a loan that way doesn't mean that any prudent lender, and the key word there is prudent, that is actually that word's in the SOP, right? It means that you as the bank still have to make smart decisions as a lender. Don't think just because you have this SBA guarantee, which is all of our tax dollars at work, just because you have an SBA guarantee doesn't mean that you can be a cowboy and just go make crazy loans and then just go sell the guarantee on the secondary market. That's not how this is meant to work. So if you're not making prudent lending decisions, the SBA may not honor the guarantee. They may come in the event of a failure and just say, no, you were being silly and you made a bad loan and you knew it was a bad loan. And because of that, we're not going to honor the 75%. We're going to, give you a fat check of 0. Right. So banks still have to make good lending decisions. And so, there's always going to be a differentiator between what the SOP says at a base level, because that is the basic rules that every bank has to play by. And then every bank then layers their own credit risk appetite on top of the SOP, and that's how loans actually get made. So that's a really good point there.
Let's talk a little bit more about seller notes. I see this as a point where a lot of negotiation happens and can happen to get a deal done. You mentioned some of the requirements if it's being used towards an equity injection: minimum 2-year standby, no balloon payment. Generally, my understanding is it needs to be coterminous with the SBA loan itself. What are some ways that you have seen seller notes be used creatively to make a deal happen? And what advice do you have for a buyer who's working on negotiating a note with a seller?
Sure. So actually, it doesn't necessarily need to be coterminous with the SBA loan. It can actually term out faster than the SBA loan, but
Mm.
they just have to be cognizant of the fact that when we underwrite it, we're going to underwrite it based on the terms that are actually there. So if you're terming it out over 5 years and the SBA loan's obviously over 10 years, the cash flow still better work with the seller note payment. Because we're going to add that into our debt service coverage ratio when we're trying to, get a real ratio together for standalone and global. So that's kind of how that works. But one of the creative ways that I've seen people use seller notes is forgivable seller notes. So essentially, because what you see often is that people would like to do earnouts, right? That's like the thing that all the smart guys who are structuring deals, they always try and structure these earnouts into it. SBA is not going to allow for that. Earnouts are not eligible. SBA does not like open-ended transactions where they don't know exactly what the final sale price is going to be. So the way to get around that essentially is you can do a seller note that essentially would be forgivable if certain metrics aren't hit. Because in that situation, we still know what the maximum sale price is going to be, but it could potentially get ratcheted down. We're okay with that. We're just not okay with the other scenario where it could potentially get ratcheted up if you really knock it out of the park. So that's one thing that I've seen happen a little bit more frequently, and I think it's a smart way to go about it. And I always think that it's smart to just have seller notes in your deal in general. I think that it keeps the seller more honest. I think that they make the transition smoother for you as the buyer when you have the seller note in there as well. For some reason, they just want to make sure the customers like you. They want to make sure the employees aren't leaving because they still have skin in the game. And I think that's an important thing. So I personally would probably never buy a business without there being some type of seller note component in it, even if it doesn't have to be a massive seller note, but even a couple $100,000 is usually enough to kind of keep somebody's interest in the deal. So yeah, I would say that as an entrepreneur, that is to your benefit to have the seller note in it. It's also to the bank's benefit, no doubt about that. It's less leverage for us, but really, it's at the end of the day, it's going to help you more than anybody else.
I'm curious to learn more from your experience as an underwriter. Obviously, the last thing someone wants to happen is to find a deal they think is great, get a term sheet they're happy with, and then have everything killed in underwriting. In your experience, what are some of the common reasons that a deal might die at that point, and how can buyers be on a better lookout to avoid those situations?
Yeah. So here's the thing: as someone who's been on both sides, right? I was an underwriter for 3 years before I became a lender. A lender should know what the weaknesses are in a deal and why it might get declined, and they should let their customer know that. Um, I really, very rarely in my life as a lender have I ever been surprised in the committee. If I talk to a customer on the front end and they tell me everything that's going on, I usually right there on that phone call, the initial phone call before I've even seen financials, will tell them what the weaknesses are in their deal. And that's something that I do with all my customers because I need to give them reality. If it's, hey, you don't have a lot of experience, your PFS is not the strongest, I want you to know that before we even go down this road, because there's a chance when I get into committee, they're going to say the same things that I'm saying to you right now. So how do we make this stronger so that when I get in there, I have some ammunition to at least fight back on your behalf and try and get this deal across the finish line? Or how do we make this weakness go away completely to where it's not even going to be a discussion point when I go into committee? Those are the things that a good lender should be doing for you. There's been some times where I've straight up told people, it's like, hey, you know what? I don't know if we're going to do this deal. I think that this deal, I believe in you. If I didn't believe in you and your ability to make this successful, I wouldn't even take it this far. But I think that you can really make this work. but I'm just going to tell you right now, there's some weaknesses in this deal that when I get into a credit committee, they may not be comfortable with this. You might get denied. And so they have to be aware of that. And I've had that type of honest conversation with people. And to be quite frank, a lot of times they understand because maybe I'm not the first bank that they've spoken to. Maybe they've already spoken to somebody else and that person wasn't even willing to go this far with them, or maybe they already got a full declination from another bank. And what you find is that people will respect honesty if it's based in fact. I mean, you can't argue with the numbers, right? It's like, hey, the debt service is skinny. You see it and I see it, right? So if you have that conversation up front and everybody's on the same page, when you get into a committee, even if it doesn't go your way, it's an easy conversation coming out. It's like, hey, sorry, unfortunately, here are the reasons why we weren't able to move forward with it. And we wish you the best. And, obviously I try and introduce them to other people who I think may be able to assist them in getting the deal done. But yeah, that's usually how those conversations work. But in reality, there shouldn't be any surprises for a lender when they go into a committee. If they understand credit, if they understand what weaknesses are and how to mitigate them, then there should never be a reason like, oh man, I just didn't think of that. After you've been doing this for a long enough time, all these deals, they start to look the same. I've seen, 300 business acquisitions and, and so they all have kind of the same components to them. They start to rhyme over a certain period of time. So you kind of understand what to look for and you can kind of school your borrowers to that.
Is there anything you see that comes up frequently as either a common misconception from buyers or some common aspect of a transaction that you see buyers overlooking, that you feel like you're frequently having to have conversations about, hey, this aspect of the deal is going to be challenging to get in front of a committee?
That's a really good question. I think that the big thing that I see a lot right now is people asking for working capital as part of the total project. Sometimes I think that I don't want to say that they necessarily over ask, but I think they also have to be realistic with how much they're asking for. Because, for example, we as a bank are not going to like it when your equity injection is 200,000, but you want 400,000 in working capital, right? So it's basically you're getting back your 200,000 that you put in, so you're basically getting 100% financing plus an additional 200,000 on top of that for your working capital. That's not really the way that it should work in the bank's eyes, right? We want to see that you have true skin in the game. So maybe if you put in 200,000, maybe you'll get 100,000 in working capital, or 75,000 in working capital, something more realistic. And it's also business dependent as well. There are some businesses that do need more working capital. And in those situations, we'd much rather lend you that working capital than have you not have it, because that can be an absolute nightmare. Running out of money is like a heart attack for a business. So we definitely not want you to be undercapitalized. But at the same time, I think sometimes customers feel like they can kind of maybe game that system a little bit and try and, put that money right back in their pocket on the day of closing. And, we don't typically go for that.
One area that I see being a bit of a point of contention are ad backs. I'm running
Oh,
into a
that's a
lot
good
of
one.
situations, yeah, where brokers can get a little creative. I think brokers and sellers creative
Sure.
with ad backs. And I know every lender thinks about ad backs differently, but that is a challenge I run into working with buyers is, they're coming in and saying, I've done my own spread. The DSCR is, amazing. You look it into a little further and it's heavily ad back based. How do you think about ad backs and how do you think that buyers can have a better understanding of what realistically a bank is going to look for and how to be on the lookout for that?
Yeah. One thing I would just say right off the bat is that if your deal only cash flows because of ad backs, that's going to be a tough sell. If that thing lost money last year on paper, and then you have to add, 15 things back in order to get it to debt service coverage, most likely it's just not a great deal. We will do ad backs, certainly, if they are substantiated and they make sense. But I mean, we're talking like 3 ad backs, 4 ad backs. If it's more than like 10 ad backs, then usually there's something weird that's going on that's probably going to need some additional explanation. Things that we will add back, if there's maybe a family member who doesn't actually work in the business that's on payroll for some reason. I see that all the time, and I'm like, man, I like what's up with my family and why don't they love me this much? But it's like, why am I? These people just getting free money and they just don't even have to show up to work. Like that's insane. But yeah, you see that type of stuff happen sometimes. People run all types of personal expenses through the business. I don't know. It's not obviously the right thing to do, but I'm also not the IRS, and it is what it is. Some people do that type of stuff, and I always tell my internal committee that we're helping out a good buyer, not a bad seller. So and we kind of navigate that. But yeah, it's common sense, right? What reasonable ad backs are, and then oh well, this is a discretionary party that we have for the employees every single month, and you don't have to do it. Well, it's like, well, but if he doesn't do it, then the employees are going to be pissed and they're probably going to leave because they're not getting treated the same way. So no, we're not going to add that back. So it kind of just comes down to common sense, and you have to realize what somebody who's buying this business is going to need to be able to spend moving forward. So one thing I would say that I see probably the most contention on is actual owner salary and how much of that to add back. Because some people will say, well, I don't need a salary from this. I have my salary from something else. And because of that, can we add back the full owner's compensation? Well, I think that a portion of that probably could be added back. I think that what we usually would like to add back is anything that's excessive. So, for example, if somebody's paying themselves $200,000 in owner's compensation, well, maybe 100,000 would be reasonable, or maybe 80,000 would be reasonable. So we'll add back the difference. We'll add back that 100,000 or 120,000, whatever we feel like is appropriate, but we're probably not going to add back the full 200,000 because we're just going to assume that you're still going to want to pay yourself something out of this, and you still have obviously lifestyle expenses, et cetera. So that's one thing that I see probably the most contention on. But one thing with the bank is the bank's always going to win that argument. So you just have to realize, in banking, there's the golden rule, and it's he who has the gold makes the rules. So if you don't like what the bank says, then you can go find another bank, or you can just not work with them. So that's your decision.
And, every lender thinks about add backs differently. So, a deal that might not be a good fit for one lender may be a good fit for another. But I would say generally add backs are a challenging area in deals that I've seen a lot of lately. So it's
Absolutely.
good to know how you think about them. Something else I want to ask you about is kind of more general about SBA. I often run into people who, are considering SBA, but they're also interested in looking at conventional options, typically because they're trying to get around the PG. That's the number one reason I see people hesitant about SBA. So I don't know if you've worked in conventional lending before, but I'm just curious to get your perspective as someone who, works in SBA and also has been an SBA borrower. What do you think are the strengths of SBA? What do you think SBA does really well? Why do you think it's a great product? And what are some situations where SBA may not be a great fit?
Sure. So I actually did work as a conventional lender for a short stint. I did about a year, a little over a year as a conventional lender in a short stint before I left my prior bank. So I did kind of see both sides of it. But one thing I can tell you right now is you are going to have an extremely difficult time finding a lender who's going to do a business acquisition conventionally. If there's no collateral, 99% of banks, especially at the dollar threshold that would be SBA eligible, are going to do a conventional loan for you. The product just doesn't exist. That's the truth. If you found it, it's like finding a needle in the haystack. And honestly, it's probably because you already have some type of substantial net worth to where a bank felt comfortable taking a risk on you. And I mean net worth to the point where maybe you didn't even need the loan in the first place. Maybe you could have bought it in cash. Those are the only type of situations I see getting any type of conventional financing for a loan that's going to be, sub $5 million. Once you get into some of these larger type of loans, 10, 15, 20, you start to get into the middle market. then you do see some lenders that will take that type of risk with you, but it's a much larger transaction with much larger room for error as well. So it's, yeah, if you're a small business buyer, if you're talking about buying something that's going to be 1 million, 2 million, good luck if you find a conventional lender. Matter of fact, if you find one, call me, because I would like to speak to them, because I've yet to meet them. And I'm starting to think that they may be like the abominable snowman. I don't think that they actually exist. So yeah, I'd say that SBA, when it comes to those types of transactions, it's the best product because it's the only product. It's the only game in town. So it's either you go and get an SBA loan, or you probably don't get a loan at all. You know, don't confuse this though with, if you have a ton of real estate, maybe for example, and you want to go and get a conventional loan and leverage up your real estate to be able to do that, then yeah, sure, you can go get a conventional loan, but that's a real estate loan. That is not a business acquisition loan. So don't get those two things confused. So yeah, I think SBA is a great product type because, I mean, what else is going to let you get 90% leverage on a business acquisition and a 10-year amortization? Yeah, sure, you have to PG it, but I got news for you. On the conventional side, most of those loans are personally guaranteed as well. I think that that's like another myth that's out there, that if you go conventional, you're not going to have to personally guarantee the loan. I did conventional lending. Everyone signed a personal guarantee over there as well. I can't think of a loan that I did that was, again, sub, $5 million that didn't have a personal guarantee on it. When you get into the larger deals, again, sometimes you have a burn off, or sometimes you have pro rata guarantees, which is a different thing. But again, even with pro rata guarantees, you are guaranteeing still. So yeah, it's SBA is a great product for business acquisition. It's, I think, the premier product for businesses of a certain size, and I think that it will continue to be until banks decide that they want to do conventional lending for business acquisitions with no collateral, essentially, which I don't think is happening anytime soon.
Sterling, I'm glad I've got you on the record saying all this, because I've been telling people this, and it's good to have some backup. There are a lot of people out there looking for conventional options, and I've said the same thing. If you find something, give me a call, because I'd love to get connected with that lender and see what they're doing.
Yeah. This is just not. Again, I've been in banking now since 2012, and I haven't seen anyone do a $500,000 biz act conventionally. It just doesn't. It's just not out there. And also keep in mind, even if they did offer you that type of financing, it's probably going to be over like a 3-year term or a 5-year term. It's not going to be over a 10-year term. So I know you think, oh, the interest rate, oh, it's so much cheaper. I mean, your payment's not cheaper on 3-year amortization than it will be on 10-year amortization, even if your rate is double. Okay, it's going to take a lot of rate to make up that difference in cash flow on a monthly basis. So yeah, I would say SBA is still the premier product for business acquisitions sub $5 million, and it's a good product. It's not even that it's the only product. It's actually a really good product that will allow you to get a maximum amount of leverage. And as we discussed today, with some of the changes now that you can do with the seller note financing as well, it's even a more attractive product. So for me, it's a no-brainer.
Sterling, to wrap us up here, I've got one last question for you. In your experience as a lender and an entrepreneur, what do you think are the qualities that make someone successful in business acquisition?
The quality I think that would make somebody successful in a business acquisition is the actual willingness to learn the business and do the work. I think that sometimes people get sold on this idea that they can just do this holdco thing, where essentially they are going to just buy a bunch of businesses and they're all going to roll up to this pretty umbrella company, and they're not going to have to do any work. They're going to be flying business class around the world, and they're going to be in Thailand sipping Mai Tais. And meanwhile, all their little workers are going to be, back doing their thing, and they're just going to get a check in the mail. And it really doesn't work that way. There is no such thing as passive business ownership, at least not at this scale, not in a small business. The pie is too small. you're not going to be able to make a living, even if you're one of those minority guys in the deck who maybe only gets 10, 20% or something like that. I mean, if you're comfortable with maybe getting a little bit of money here and there, maybe you can find some type of situation like that. But for the most part, the people who are buying these businesses using SBA loans, they're usually buying 100% of the business, and they're going to be the 100% owner, and they are going to learn how to operate that business. And if they don't learn how to operate that business, then they're usually going to fail. So again, it comes back to, you have to be willing to burn your boats, learn your business, roll your sleeves up, go meet your employees, go meet your customers potentially as well, and actually be the operator of your business. That is what's going to make you successful. If you're not willing to do that, then probably not a good candidate for a business acquisition.
That is fantastic advice. I couldn't agree more. Sterling, thank you so much for taking the time to talk with me today and sharing all of your knowledge. I'd love for people to know, how can they find you online? How can they connect with you?
Yeah. So first of all, you can email me. It's sterling.birdsong@creditbench.com. The word credit and the word bench, that is my work email. So you can certainly reach me there. And then I'm also on just about every social media platform that I'm aware of. And I'm under Sterling SBA. So you can find me on TikTok, Instagram, Twitter as well. And I have a YouTube channel, which is also called Sterling SBA. So you can check out my content there. We do videos where we go back and we speak to some prior customers or some people who maybe work in the industry as well. I just did a video that released today with Sam Rosati from Pursuant Capital. He is the SMB guy, as I call him, one of the original search fund entrepreneurs. So he knows all about entrepreneurship through acquisition, and we talk about that in depth. So we have a bunch of interesting stuff that we share in terms of content as well. So yeah, check us out.
Sounds great. Well, I'll definitely link to your socials in the show notes. And thank you again for taking the time to talk with me. Enjoy the rest of your day.
Absolutely. You as well.
Thanks for checking out this episode of So You Want to Buy a Business. If you're enjoying this show so far, please like and subscribe. Be sure to check out the show notes for links to Sterling's socials, and I'll also include how you can get in contact with me. I'm an SBA loan broker, and I focus on debt amounts from $250K to $10 million. So if you're looking for some financing options for your next acquisition, let's get in touch. I'll see you in the next episode.